Hey everybody, welcome back to another series on Fishing for Pips. You all know my page is all about information, education, knowledge, understanding, and wisdom, motivation, and inspiration. Nice? So we're going to talk, this is part 2 of my last video about risk and losses. But we're going to talk a little bit about stop loss. Again, now, the stop needs to go where the stop needs to go. The market makers do not care about if you only want to use a 10 pip stop. Alright? They don't care if you only want to risk 20 pips. The stop needs to go where the stop needs to go. You can go 1 ADR outside of your entry. You can go a whole ADR and a half outside of your entry. You need to leave room for fluctuation, right? The market is a fluctuating tool. You need to leave room for that. You cannot be placing big lot size and tight stop loss to limit your risk. Yeah, you can use small lot size, use wider stop loss, and still make decent money because, like the levels that we trade, the ADRs that we trade, we could still risk 100 pips on a 0.01. So you could start with $100. You can risk 100 pips with a 0.01. Only spend net $10 from your $100. Go for 1 to 5 on the ADR, on the levels, on the cycles that you all see I just be showing, and make $50. So you risk 10 to make 50. You risk 100 to make 500 because the market runs the cycles in 1,000 pip increment moves. So that's how we could target and have a forward-looking implied volatility that we're going to achieve that. And we trade in between a 1 month to 3 month time horizon, 20 days to 60 days, and it happens sometime in 2-3 weeks, and 1 week sometimes, whatever the case may be. And according to the pair that we trade in and the pip count of that pair, so like, gold is a higher pip count. GBP is a higher pip count than EUR/USD. Right? GBP USD is a higher pip count than a EUR/USD. Right? So there are some that is less, some that is more. So according to which one we trade in, we will target either 0 to 250, or 250 to 500, or 500 to 750, and then 750 to 1000. Nice? But the stop needs to go where the stop needs to go. The market makers here do not care about you want to use a 10 pip stop because you see a high over here and you want to risk right above that high, and your entry is down here. They come up and hit you bam, bam, bam. You want to put it there. You think you want to use a big lot size. You want to have your entry here. You want to have your stop loss right above this high here. Whatever the case may be. The stop needs to go where the stop needs to go. If the stop needs to go up there, so it be. Put it up there. Control your lot size. The better entry structure you get, you can bring it down. But if it's a case that you're in a phase of the market that you see another push-up could be imminent, another push-up can be valid, you need to go where you need to go. The stop needs to go where the stop needs to go, right? So the market makers don't care about your 50 pip stop loss and think, well, the market makers don't care about your 75 pip stop loss. If you gotta go a whole 100 outside of that, you gotta go a whole 100 outside. If you have to go an entire ADR, go there. Control your lot size. You control the volume on your lot size. You can lower it down or raise it up, lower it down or raise it up. Sometimes you get a properly well structured, and we could see and understand with the information that we know the dealers wouldn't come back in that area. So we wouldn't use such a big range for our stop in a case like that. Nice. But if we see that there's potential of them actually going to different places before turning around, and we use a red light, green light, amber light type of situation, nice, we will actually leave a proper breathing room. The stop needs to go where the stop needs to go. So I wanted to break that down for you guys. Market makers doesn't care about where you want to put your stop. Put the stop where the stop needs to go. Now I'm going to show you guys a formula. This formula will make you understand how to stack the odds in your favor with your application when it comes to stop loss and risk and stuff. Your risk to reward also. Nice. Because as a retail trader, you want to play the game to win. Yeah, you want to play the game to make money. That's what you're here for. You're here to make money. You're not just coming here and operating in financial markets because the media say this or somebody say this on a video or somebody. You have to know exactly what you're doing here. You have to know exactly what you're doing. Yeah, and position yourself in the areas of financial markets and use the formulas for you to make money consistently. All right, so let's say 1-to-1. Some people use 1-to-1. Why we wouldn't play those games? 1-to-1 R ratio, 1-to-1 risk to reward. Why we wouldn't use a 1-to-1 risk to reward? If we take 5 trades, 1, 2, 3, 4, 5. We risk 10 to go for 10. If we risk 10 to go for 10, that's a 1-to-1, right? You're risking $10 to go for $10. And you do this across 5 positions, 5 trades. If you lose this trade, you lose this trade, you lose this trade, which one of them is picking up for the loss and still have the potential to put you in net profit? None. So if you expose $10 here, you expose 10 here, 10 here, 10 here, 10 here. When you lose this one, and that's why people try to win more trades than lose trades to make money. You don't have to win more trades and lose trades to make money. You will not win more trades and lose trades, especially with the strategies that you're using and the information and the education that you're applying. And even if you're winning more trades and you're losing trades, your risk to reward and what you're using, whenever the market goes wrong, and whenever you suffer, a whole losing streak, you're actually going to blow up. And you're going to have much more losses and you're going to lose a lot. Nice. So even if you're scalping, and you realize you have 10, 15 nice little scalps in a row, and you tell yourself, I'm winning more trades than losing trades because you only lost one of the positions that you actually scalp 10. Yes, you do 10 scalp and you only lose one, and you tell yourself you have a 90% win rate because 9 of these scalp went too good and 1 didn't go too good. You're still not going to be making money. You're still not going to be consistent. Whenever you lose, you're going to blow up. And whenever you lose consistently, it's going to blow up. And all the money that you make this week, this month, you're not going to have it next month and next year and next week. Yeah. Sometimes you lose it back the same day. Sometimes you actually lose it back the same day. So in a case like this, you lose this one here. You lose this one. You lose this one. You lose this one. If you win this one, you still can't pick up. You still can't cover for these here. If you win this one and you win this one, here and here, nice, you still can't pick up. You're not making no money. You're wasting time. 1-to-2. If you're using 1-to-2, 10 for 20. 10 for 20. Yeah? You lose this one. You win this one. You nile over here. Yeah? If you have another position, you lose this one. You lose this one. You win this one. What happens? You nile here. If you have another one, you win this one. You lose this one. What happens? You're in a loss. Because you only make 20. You never cover the 30. You're in a deficit. In a percentage decrease. 1-to-3. 10 for 30. 10 for 30. And you will see as I go up and I spread it out more, 10 for 30, 10 for 30, 10 for 30. That's a 1 to 3. What happened there now? If you lose this one and you win this one, yeah, you have a 20 profit. If you lose this one and you win this one, you have a 10 profit. You get to cover with $30, you get to cover 20 loss here, and you end up with $10 still. Nice. If you got 10 again, yeah, and you win this one, and you lose this one, what happens there now? You nile. So you are now flat. If you have another one, and you win this one and you lose this one, what happens there? You're now in a loss because you can't cover the 40. 10, 20, 30, 40. But it's only $30 profit you get. Nice. Which means you're in a deficit now of $10. So this formula, you cannot lose more and win less and actually still profit. If you take a certain amount of positions in your portfolio, you want to see 1, 2, 3, 4 being lost, 1 being profiting, 1 you're winning, and covering for all those and still keeping your net profit. And that's why when we do the levels like this, and we see 500 ADR per level, and we go for that 1 to 5 or 1 to 4, that is where we can actually get that happening for us. So if we go 10 for 50, 10 for 50, 10 for 50, 10 for 50, we got 5 positions, 1, 2, 3, 4, 5. If we lose this one, win this one, we still 40 profit. If we lose this one, win this one, I'll mix up this thing here a little bit. Alright. So if we lose this one here, in the middle, if we lose this one and we win this one, we still $20. We're still in profit. We're still in net profit overall. If we lose this one and we win this one here, we're still in net profit. We're still in net profit. So we could lose majority here. Win less, still profit. That is what, once you do that with this, you will realize you're actually going into a loss. Going into a loss, going into a loss, going into a loss, going into a loss. And that's why people try to press towards winning more trades than losing trades. But it's inevitable that sometimes you will not win more trades than you lose trades. Sometimes you will have a little winning streak, then a losing streak, because you don't have the wrong information, trading with lines and zones and indicators and all these different retail stuff and application and stuff, right? So when we use the portfolio and we use the levels and cycles, and we target these things, and we use the 1 to 4, 1 to 5 R ratio, and we put either 3 long on, 3 shorts, or 5 longs and 5 shorts, or 10 long and 10 shorts, this formula actually, and we get full home run on these things. So all the 5 going long, full home run. All the short, 5 short, 5 longs, all of them going down. We get any 1 to 5. Sweet, full home run. Long, same thing. Nice. But if anything is to change up in the portfolio and 1 or 2 of them don't play out, we just never lose it. Trades not playing out, but we always in net profit. You have to know how to lose trades all the time, but make money all the time. Which means even though everything doesn't play out, because we're using this formula, we're always in net profit. We're always in net profit. Or every quarter, every month, every quarter, every month, every year, we're always in net profit with this formula here. So this is how We say you can't make money all the time, you can't win all your trades, you can't make money all the time. Yes, you could make money all the time with a formula like this. And with the knowledge and education that we have, with these cycles and these levels and what we get out of them and what we aim for, even if we have a bad market condition and we lose more trades than we win trades, still making profit. If we win 2-3 out of all, still making profit. If we get a full home run, massive money we making. Right? Because we could have a very small exposure here, nice, and end up with a decent amount of money. Yeah, so this is a little formula here. And if you guys understand this formula properly and apply it properly with the cycles, the levels, the counts, the dealers template, trade in line with the banks, trade in line with the big boys, trade in line with the hedge funds, trade in line with the market makers. Yeah, I'm telling you, the trading will change forever. Start making money. 2026 coming. Let's kill it in financial markets. See you guys on the next one.